All right, let's jump right in. Today, we're tackling a huge question in the crypto world. Is trading just a high-tech casino, or can you actually approach it with a real, disciplined strategy? Well, we're going to break down the framework that helps you do exactly that.
So let's get right to the heart of it, the question that hangs over this entire space. Is this all just a massive gamble, a roll of the digital dice? Or is it more like a chess match where you can use strategy and calculated moves? The answer, you'll see, is all about understanding the game you're playing.
Okay, so first things first, we need to learn how to read the map. Before you can even think about navigating the crypto markets, you have to understand what the charts, all those lines and bars, are actually trying to tell you. This is our foundation.
And our main tool for this is what's called technical analysis, or TA for short. Think of it like learning to read the market's body language. The whole idea is that by looking at past price movements and trading volume, we can start to spot patterns and probabilities. Now, it's not a crystal ball, but it helps you understand the current weather so you can navigate the storm a little better.
TA is really built on three big ideas. First, the price reflects everything. All the news, all the hype, all the fear, it's all already baked into that number you see on the screen. Second, history tends to repeat itself. Why? Because human psychology, the greed, and the fear doesn't really change. And third, prices move in trends. They don't just move around randomly.
Two of the most basic but powerful concepts in TA are support and resistance. The easiest way to think about them is as psychological floors and ceilings for the price. Support is a price level where buyers tend to show up and create a floor, stopping the price from falling further. Resistance, on the other hand, is a ceiling where sellers tend to take control. Just identifying these zones is your first step to mapping out the battlefield.
But here's the thing. The charts don't tell you the whole story. Not even close. A really skilled trader knows how to look beyond the price to get the full picture. You gotta understand the why behind the market's moves.
And for that, we have three other key tools in our toolkit. First is fundamental analysis. This is like being a detective for the project itself, digging into its technology, its team, its purpose, to figure out if it's actually valuable. Then you have on-chain analysis, which is super unique to crypto. It's like having a window into the blockchain to see what the big money, the whales, are doing. And finally, sentiment analysis, which is all about measuring the market's emotional temperature.
And that brings us to market psychology. Things like the Fear and Greed Index show that when the market is in extreme fear, it can often be a fantastic buying opportunity. Why? Because everyone else is panicking. And on the flip side, when you see extreme greed, that's usually a huge warning sign that things might be getting overheated. It really comes down to that famous saying, right? Be fearful when others are greedy, and greedy only when others are fearful.
Okay, now we've arrived at what is, without a doubt, the single most important part of this entire discussion. I'm serious. You could be the best analyst in the world, but if you don't master this next concept, you will fail. I'm talking about risk management.
Here's the absolute truth. Your analysis skills are your offense. They help you find opportunities and score points. But risk management, that's your defense. And defense is what keeps you in the game. It's the discipline that makes sure one bad trade doesn't take you out completely, so you can live to fight another day.
So what does that look like in practice? Well, there are three non-negotiable rules for survival. Number one, position sizing. You never, ever risk more than 1 to 3% of your total trading capital on a single idea. That way, no single loss can ever wipe you out. Number two, always calculate your risk-to-reward ratio. And number three, which we'll get into, is always use a stop loss.
So let's quickly break down that risk-to-reward ratio. It's a really simple idea. First, you define your risk. You decide, okay, this is the absolute maximum I'm willing to lose if this trade goes wrong. Let's just call that 1 unit of risk.
Now for the other side of the equation. For that 1 unit of risk you're putting on the table, you should be targeting a potential reward that's much, much bigger. In a really good setup, you'd be aiming for a reward of at least 3 units.
And this is where the magic happens. With a 1 to 3 risk-to-reward ratio, you can be wrong 3 out of 4 times and still break even. It completely shifts the odds in your favor. It means you don't have to be right all the time to be profitable. You just need your wins to be bigger than your losses.
So how do you actually enforce that risk? You use a stop loss. It's an automatic order you place that basically tells the exchange, hey, if the price drops to this specific level, sell my position immediately, no questions asked. It's your financial circuit breaker. It takes the emotion completely out of the decision and forces you to stick to your plan.
Another piece of control is understanding your order types. A market order is basically you shouting, just get me in or out right now at whatever the best price is. It's fast, but you don't control the price. A limit order, on the other hand, is you saying, I am only willing to buy or sell at this exact price or better. It gives you total control and, fun fact, usually comes with lower trading fees.
Okay, so let's tie all of this together. We've talked about analysis, we've talked about market mood, and we've covered the ironclad rules of risk management. How do we combine all these pieces into a strategy that you can actually use?
It comes down to this simple but incredibly powerful framework. You use fundamental analysis to decide what assets are even worth your time and money. Then you use technical analysis to figure out when the right moment to buy or sell might be. And finally, and most importantly, you use strict risk management to decide how much you're going to commit to that trade. What, when, and how much. That's the whole game.
And I want to leave you with this final thought. The goal here is not to be a perfect predictor of the future, because that's impossible. The real goal, the true definition of success in trading, is managing your losses so that you can survive your mistakes. It's all about longevity. So the question isn't just, how do I win? It's how do I make sure I never lose the ability to keep playing?